Mention derivatives and most people might think of Nick Leeson, highly risky financial instruments, or citywide boys making lots of money to fund their Ferrari lifestyles. But for most investors, a derivative is a way of hedging their bets. Now for pension schemes, hedging can be a really good thing. It allows the pension scheme to benefit from unexpected price movements. So for example, a fall in the equity market, or perhaps more importantly, a rise in the liability value. Now derivatives started out in industry, allowing perhaps a farmer and a trader to agree on the price of coffee in 3 months' time, protecting both the buyer and seller from adverse conditions in the intervening period. Now it's no surprise derivatives soon stretched to the financial markets, entering equities, bonds and currencies. Now in pension schemes, the two types of derivatives most commonly used are options and swaps. An option allows an investor to agree on a price but still benefit should price movements move in their favour. Whereas a swap allows an investor to exchange a series of payments. Most commonly used in a pension scheme is the exchange of floating cash flows for fixed cash flows. This allows us to hedge against our liabilities. Now, anyone who's ever had a fixed rate mortgage, for example, has been given this mortgage because a swap exists behind the mortgage contract. So going back to our original example, a derivative is more flexible than an investment in the underlying product. Using a derivative, we can benefit from the changes in price to an underlying investment without actually making an investment into the underlying product. Now this allows us to profit should markets fall, or in the case of pension schemes, profit should liability values rise. Now, derivatives can be risky. That statement has some truth to it, but for most investors, a derivative is a way of hedging their bets or reducing the risk of their investments. For pension schemes, derivatives are one of the best tools trustees can use to help them control the risk of funding levels, and if they can control the risk of funding levels, they can improve member security.